What if your money could quietly disappear tomorrow? That thought alone keeps many investors awake. Markets shift suddenly, often without clear warnings. Fortunes rise quickly, yet fall even faster. One wrong move can undo years of effort, but there is a smarter, safer approach. It begins with understanding the power of diversification. Diversification means spreading risk across different investments wisely. It protects you when one area starts failing. Think of it like not trusting one basket. If that basket falls, everything breaks instantly. Multiple baskets reduce damage from unexpected accidents. The same principle applies perfectly to investing strategies. Smart investors rarely depend on one income stream. They build layers of financial protection gradually. Each layer supports stability during uncertain times. This approach does not eliminate risk entirely. However, it significantly reduces potential financial losses. Diversification works because markets behave differently simultaneously. Some sectors grow while others struggle quietly. This natural imbalance creates valuable protective opportunities. You simply need to position yourself correctly. Start by identifying your current investment concentration. Many beginners unknowingly place everything in one category. This creates unnecessary exposure to sudden downturns. Awareness is the first step toward improvement. Once aware, you can start making smarter decisions. Consider different asset classes for better balance. Stocks are popular but come with volatility. Bonds offer stability but usually lower returns. Real estate provides steady income and long-term growth. Each asset behaves differently under economic conditions. Combining them creates a stronger financial foundation. Do not rush into changes without proper understanding. Take time to learn how each asset works. Knowledge reduces fear and improves decision-making ability. It also helps you avoid emotional investing mistakes. Emotional decisions often lead to poor financial outcomes. Discipline plays a key role in diversification success. Stick to your strategy even during market fluctuations. Short-term noise should not shake long-term plans. Patience allows your diversified portfolio to perform effectively. Many people expect instant results from investments. This expectation often leads to unnecessary risks. Diversification rewards those who think long-term consistently. It is not about quick gains overnight. It is about building sustainable financial security gradually. Start small if resources are currently limited. Even small diversification steps can make difference, and over time, these steps create significant impact. Reinvesting earnings helps grow your diversified portfolio faster. Compounding works best with consistent and disciplined actions. Avoid putting all money into trending opportunities. Trends can reverse unexpectedly and cause losses. Balance excitement with careful and logical thinking. Research thoroughly before committing funds anywhere. Reliable information is essential for safe investing decisions. Avoid following advice blindly without understanding context. What works for others may not suit you. Personal goals should guide your investment strategy. Define your financial goals clearly before diversifying. Goals provide direction and purpose to your actions. They also help measure your progress over time. And risk tolerance varies from person to person significantly. Understand how much loss you can comfortably handle. This understanding shapes your diversification choices effectively. Younger investors may take slightly higher risks. Older investors often prefer stability and predictable returns. Life stage influences your investment approach naturally. There is no one-size-fits-all diversification strategy. Customization is key to long-term financial success. Keep learning as markets continue evolving constantly. Adapt your strategy when circumstances change significantly. Flexibility ensures your portfolio remains resilient over time. This is just the beginning of your journey. Now the basics are clear, expand your strategy further. Diversification goes deeper than just choosing asset classes. You must also diversify within each category wisely. Stocks, for example, come from many industries. Technology companies behave differently than healthcare businesses. Energy stocks react strongly to global supply changes. Consumer goods often remain stable during uncertain times. Spreading investments across industries reduces concentrated sector risk. If one sector struggles, others may perform better. This balance keeps your portfolio more stable overall. Geographic diversification adds another important layer of protection. Investing only locally limits your growth opportunities significantly. Different countries experience different economic cycles simultaneously. Some regions grow while others face temporary slowdowns. Global exposure allows you to capture wider opportunities. It also reduces dependence on a single economy. Currency movements can impact international investments as well. This adds complexity, but also potential for additional gains. Consider mixing developed and emerging markets thoughtfully. Developed markets offer stability and reliable growth patterns. Emerging markets provide higher growth, but increased volatility. A balanced mix can improve long-term portfolio performance. Investment vehicles also play a crucial diversification role. Individual stocks require careful research and constant monitoring. Mutual funds pool money to diversify automatically. Exchange-traded funds provide flexibility and broad market exposure. These tools simplify diversification for many investors. They reduce the effort needed for portfolio management. However, always understand what each fund contains. Blind investing can still lead to unexpected risks. Review fund holdings regularly to maintain alignment. Overlapping investments can reduce true diversification benefits. Avoid holding too many similar assets unknowingly. Quality matters more than the number of investments. Too many holdings can make management complicated. Focus on meaningful diversification rather than excessive variety. Allocation percentage determine your portfolio's risk profile. Decide how much to invest in each category. Higher stock allocation increases potential returns and risks. More bonds can provide stability during market downturns. Real estate adds income and inflation protection benefits. Adjust allocations based on your goals and timeline. Regular rebalancing keeps your portfolio aligned with targets. Market movements can shift your original allocation significantly. Rebalancing restores your intended investment proportions carefully. This process also encourages disciplined buying and selling. You sell high-performing assets and buy underperforming ones. This strategy helps maintain balance and manage risks. Set a schedule for reviewing your portfolio consistently. Quarterly or yearly reviews are commonly effective choices. Avoid reacting to every small market movement emotionally. Frequent changes can increase costs and reduce returns. Long-term focus remains essential for diversification success. Costs and fees can impact your investment returns. High fees slowly reduce your overall portfolio growth. Choose cost-effective investment options whenever possible. Low-cost funds often outperform expensive alternatives over time. Transparency in fees helps you make better decisions. Tax considerations also influence diversification strategies significantly. And different investments have different tax implications over time. Plan efficiently to reduce unnecessary tax burdens. Tax-efficient investing improves your net returns consistently. Use available accounts that offer tax advantages. This adds another layer of financial efficiency. Avoid chasing past performance when selecting investments. Past success does not guarantee future results. Focus on fundamentals rather than recent popularity trends. Strong fundamentals often indicate long-term stability potential. Stay cautious of overly complex investment products. Complexity can hide risks that are difficult understanding. Simple strategies often prove more effective long-term. Clarity builds confidence in your investment decisions. Consistency matters more than occasional aggressive moves. A steady approach reduces stress and improves outcomes. You are now building a stronger investment mindset. As your knowledge grows, refine diversification with precision. Risk management becomes more important at this stage. Every investment carries some level of uncertainty. Always, your goal is balancing risk with potential reward. Understanding correlations helps improve diversification effectiveness significantly. Correlation measures how investments move relative together. Highly correlated assets rise and fall together. Low correlation assets behave independently during market changes. Mixing low correlation assets strengthens your portfolio stability. This reduces overall volatility during uncertain economic periods. For example, stocks and bonds often differ behavior. When stocks decline, bonds may provide some support. This relationship helps smooth out extreme fluctuations. Commodities can also add unique diversification benefits. Gold often performs well during economic uncertainty periods. It acts as a hedge against inflation pressures. Including commodities adds another protective layer strategically. However, avoid overexposure to any single commodity. Balance remains the foundation of effective diversification. Cash is often overlooked, but remains important. Holding some cash provides flexibility during opportunities. It allows you to act quickly when markets drop. Cash also reduces overall portfolio volatility slightly. However, too much cash limits growth potential significantly. Find a balance between liquidity and growth goals. Alternative investments can further diversify your portfolio. These include private equity, hedge funds, collectibles. They they may offer returns and linked to traditional markets. However, they often require deeper understanding and research. Liquidity and alternatives can be limited sometimes. Invest cautiously and only with proper knowledge. Avoid putting large portions into unfamiliar investments. Simplicity often leads to better long-term consistency. Inflation is another factor affecting your investments. It reduces purchasing power over time gradually. Diversified portfolios can help combat inflation effectively. Real assets often perform better during inflation periods. Real estate and commodities provide some protection here. Stocks may also outpace inflation over long periods. Fixed income investments may struggle during high inflation. Adjust your strategy when inflation trends change. Interest rates also influence investment performance significantly. Rising rates can impact bonds and stock valuations. Falling rates often support borrowing and economic growth. Understanding these dynamics improves your investment decisions. Avoid making decisions based on short-term predictions. Markets are complex and often unpredictable systems. Focus on structure rather than constant forecasting attempts. Automation can help maintain discipline in investing. Automatic contributions build consistency without emotional interference. This habit strengthens long-term portfolio growth steadily. Dollar cost averaging reduces timing risks effectively. You invest regularly regardless of market conditions. This smooths out purchase prices over time. It reduces the impact of market volatility significantly. Review your goals periodically as life changes occur. Career shifts may affect your investment capacity. Family responsibilities may change your risk tolerance. Adjust your diversification strategy accordingly when needed. Avoid drastic changes based on temporary emotions. Fear and greed are common investing pitfalls. They often lead to poor timing decisions. A structured plan helps control emotional reactions. Education remains your strongest tool in investing. Continue learning from reliable and trusted sources. Markets evolve and knowledge must evolve alongside. Stay curious and open to new insights, but remain cautious of unverified information sources. Build a system that works for you. Consistency matters more than chasing perfect strategies. Even imperfect plans can succeed with discipline. Over time, small decisions create significant results. Trust the process and stay committed long term. Your portfolio will gradually become more resilient. You are now thinking like a strategic investor. Now your strategy needs strengthening through smart execution. Planning alone means little without consistent disciplined action. Execution transforms ideas into real financial progress gradually. And start by creating a clear investment allocation plan. Define percentages for each asset class carefully. Write this plan down for accountability and clarity. A written plan reduces impulsive decision-making risks. It serves as your guide during uncertain moments. Consistency in contributions builds long-term financial momentum. Invest regularly even when markets seem unpredictable. Waiting for perfect timing often leads nowhere productive, and markets reward consistency more than perfect predictions. Set automatic investments to maintain discipline effortlessly. Automation removes emotional hesitation from your decisions. Over time, this habit strengthens your financial stability. Rebalancing should become part of your routine schedule. Markets naturally shift your portfolio away from targets. Regular adjustments keep your risk levels aligned properly. Rebalancing forces you to sell high-performing assets. It also encourages buying undervalued opportunities strategically. This disciplined approach enhances long-term portfolio performance. Avoid overreacting to short-term market volatility events. Daily price movements often reflect noise, not fundamentals. Long-term trends matter more than temporary fluctuations. Stay focused on your overall investment objectives. Keep your emotions separate from financial decisions always. Emotional investing often leads to costly mistakes. Fear may push you to sell prematurely. Greed may tempt you into risky investments. Balance your mindset with logic and with patience. Tracking performance helps you stay informed consistently. Review returns periodically, but avoid obsessive checking habits. Too much monitoring can increase stress unnecessarily. Focus on progress over months, not daily changes. Use simple tools to track your investments effectively. Clear data helps you make better decisions. Transparency builds confidence in your overall strategy. Consider professional advice when facing complex decisions. Financial advisors can offer valuable insights and guidance. However, choose advisors with proven credibility carefully. Understand their recommendations before acting on them. Never rely entirely on external opinions blindly. Maintain control over your own financial decisions. Diversification should evolve as your wealth grows steadily. Larger portfolios may require more refined strategies. You may explore additional asset classes gradually. However, avoid unnecessary complexity without clear benefits. Simplicity often remains powerful even at higher levels. Risk management should remain your constant priority always. Protecting capital is is as important as growing it. Avoid investments that promise unrealistic guaranteed returns. Such offers often carry hidden risk or scams. Stay grounded in realistic expectations and careful planning. Build multiple income streams through diversified investments. This increases financial security and independence over time. Income diversification complements asset diversification effectively. Rental income, dividends, and interest create balance. These streams reduce reliance on a single source. Emergency funds should remain separate from investments. This prevents forced selling during financial difficulties. Liquidity planning strengthens your overall financial resilience. Always prepare for unexpected life events realistically. Insurance can also support your financial safety net. It protects against sudden losses beyond investments. Diversification extends beyond markets into life planning. A holistic approach creates stronger long-term stability. Stay committed even when progress feels slow. True growth often happens quietly over time. Avoid comparing your journey with others constantly. Each financial path is unique and personal. Focus on improving your strategy step by step. Small improvements compound into significant long-term gains. Discipline will always outperform short-term excitement. Your patience is building something powerful and lasting. You are now closer to true financial security. Now everything comes together into a powerful strategy. Diversification is no longer just an abstract concept. It has become your shield against uncertainty. Every decision now carries more purpose and clarity. You understand risk is part of the journey, but you no longer fear it blindly anymore. Instead, you manage risk with thoughtful structure. Your portfolio reflects balance, patience, and discipline. Each asset plays a role in stability. No single failure can break your system easily. This is the strength of true diversification. It transforms vulnerability into controlled and manageable exposure. Over time, confidence replaces hesitation in decisions. You begin trusting your process more deeply. That trust builds consistency in your actions. Consistency leads to measurable financial progress steadily. You stop chasing quick gains and shortcuts. Instead, you focus on sustainable long-term growth. This mindset separates successful investors from the rest. You now think beyond temporary market movements. Your vision extends toward years, not days. This perspective changes how you react completely. Market drops become opportunities rather than threats. You see value where others see fear. Discipline helps you act when others hesitate. Patience keeps you steady during uncertain times. Together, they strengthen your financial resilience significantly. You continue learning and refining your strategies. Growth never stops in the investing journey. New opportunities will always emerge in markets. Your diversified approach prepares you to adapt. Flexibility allows you to adjust without panic. You are no longer dependent on luck alone. Your success is built on structured decision making. Mistakes may happen, but they become lessons. Each lesson improves your future investment choices. You understand that perfection is not required. Progress matters far more than flawless execution. Over time, your portfolio gains true strength. It weathers storms and captures growth effectively. Financial security becomes a realistic and reachable goal. This security provides peace of mind daily. You feel more in control of your future. That control brings confidence into other life areas. Money becomes a tool, not a stress source. Diversification helps you achieve that transformation gradually. It protects your efforts and rewards patience. Your journey inspires smarter financial habits continuously. Others may notice your disciplined approach eventually, but your focus remains on personal growth. You stay committed to your long-term vision. Short-term distractions lose their influence over time. You measure success through stability and progress, not through sudden spikes or risky bets. Your strategy continues evolving with your life. Adaptation keeps your portfolio strong and relevant. You remain aware, but not overwhelmed by markets. Balance defines your decisions moving forward always. This is how lasting wealth is truly built, step by step, choice by choice daily. You have created a system that supports you, a system designed for growth and protection. This is more than investing. It is empowerment. You now hold the knowledge to move wisely and the discipline to act consistently forward. The journey continues, but your foundation is strong. Every future step becomes more confident and clear. You are prepared for both challenges and opportunities. This balance defines a successful investor's mindset. Remember, diversification is your strongest long-term ally. Protect it, refine it, and trust it. Your future depends on the choices today. Make them wisely with patience and clarity. Your financial story is still being written, and now you are writing it wisely.